Did you know that the US national debt has soared to over $33 trillion? That's more than the entire GDP of China and Japan combined. But here's the big question: can the president actually control the economy, or are they just along for the ride? You've probably heard it countless times: presidents are the ones who steer the economy. When things go well, they get the credit. When things go badly, they take the blame. But is it really that simple? Can one person really control such a complex system? In this video, we'll dive into how much power presidents truly have over the economy. We'll explore surprising facts like how a president's tax cuts might boost the economy, but also lead to massive debt. You'll also learn about powerful forces like the Federal Reserve and global markets that have just as much, if not more, influence. Stick with us as we break down the myth, look at real-world examples, and reveal the surprising truth behind presidential power in the economy. Chapter 1: The Economic Myth. Debunking presidential power. It's a common belief, the president holds the power to control the economy. But let's start by busting that myth. While the president can influence certain economic policies, they don't have the power to dictate every aspect of economic life. The US economy, like most, is a complex system involving many players: Congress, the Federal Reserve, and private sectors, just to name a few. Presidents may propose budgets or introduce new taxes, but their control ends when it's time for Congress to approve them. The famous checks and balances system means the president can't act alone. For example, during the Great Recession of 2008, President George W. Bush proposed a massive bailout package, but it wasn't until Congress approved it that the economy saw a shift. Another misconception? The idea that a president can simply turn on or turn off economic growth. That's not how it works. While policies can shape conditions, long-term growth often depends on things like consumer confidence, technological progress, and global market trends. In fact, a study by the National Bureau of Economic Research shows that while the president's economic policies can influence short-term growth, they are far less impactful in the long run. Some argue presidents do more harm than good in the economy. Take President Nixon's wage and price controls during the 1970s, which led to stagflation, a period of both high inflation and unemployment. Policies like these show how well-intended decisions can sometimes backfire. So, does this mean presidents are powerless? Not exactly. They still play a key role. A president can rally the nation for urgent economic actions, as Franklin D. Roosevelt did with his New Deal during the Great Depression. But even Roosevelt needed Congress and the Federal Reserve to implement his ideas. While presidents don't control the economy entirely, they do guide it. Whether they're cutting taxes or raising interest rates, their decisions can nudge the economy in different directions. But the broader economic forces are often bigger than any one person. In short, presidents can influence but not completely control the economy. It's a collaborative effort that involves many moving parts. So, the next time someone says a president controls the economy, remind them of the larger picture. Chapter 2: From FDR to Biden, How History Shaped Economic Power. To understand how presidents have shaped the economy, let's take a look at history. Franklin D. Roosevelt's New Deal in the 1930s was a game-changer. Facing the Great Depression, FDR introduced massive public works programs to combat unemployment. While the economy didn't fully recover overnight, those policies helped lay the groundwork for modern welfare programs like Social Security. Then, there's Ronald Reagan. When he took office in 1981, he embraced supply-side economics. He slashed taxes, hoping that it would boost investments and create jobs. Critics called it a trickle-down theory, arguing that the wealth would only benefit the rich. However, Reagan's tax cuts did stimulate economic growth, and during his presidency, the US saw a huge drop in inflation and unemployment. More recently, President Barack Obama faced the aftermath of the 2008 financial crisis. His administration passed the $787 billion stimulus package to revive the economy. Though controversial, this package helped stabilize the economy and reduce unemployment. The unemployment rate dropped from 10% in 2009 to 4.7% by 2016. A 2017 study from the Congressional Budget Office even found that the stimulus saved or created 2.5 million jobs. Under President Donald Trump, the tax cuts passed in 2017 became a hot topic. These cuts were designed to boost business investments and wages, but the benefits were not as widespread as anticipated. Some studies indicated that large corporations benefited more than ordinary workers. Critics argue that it led to increased federal debt without significant long-term economic growth. Now, under President Joe Biden, there's a shift towards a more progressive economic agenda. His administration's $1.9 trillion American Rescue Plan aimed to help working families recover from the economic challenges caused by the pandemic. While it spurred job growth, inflation also rose. The economy has seen a recovery, but questions about the long-term impact of such high levels of government spending remain. Looking back at all these presidencies, we see that while each president has tried to push the economy in their direction, they often faced obstacles beyond their control. Global events like oil crises, financial crashes, and pandemics have shaped the economy as much, if not more, than presidential decisions. So, what have we learned? Presidents certainly play an important role in guiding the economy, but they're not always in control. Their decisions interact with global forces and Congress, which often determines the ultimate economic outcome. Chapter 3: The Invisible Hand. Who really calls the shots? When we talk about the economy, we often think of politicians calling the shots. But there's another player that deserves attention: the market itself. The so-called invisible hand of the market, a concept first introduced by economist Adam Smith, suggests that individual decisions made by consumers and businesses ultimately guide the economy. Take, for example, the stock market. While presidents may have opinions on economic policies, the stock market doesn't always follow their lead. In 2016, President Trump's election initially caused volatility in the market. However, by 2017, stocks surged as investors expected tax cuts and deregulation. It wasn't Trump's direct actions, but investor sentiment and business decisions that influenced the market's movement. The Federal Reserve is another force beyond the president's reach. This independent body controls interest rates and manages inflation. Presidents can nominate Fed leaders, but they cannot directly dictate its policies. When President Biden appointed Jerome Powell for a second term in 2022, the market had mixed reactions, but Powell's decisions on interest rates remained independent of presidential influence. In the modern world, multinational corporations are also key players in shaping the economy. Apple, Amazon, and Google, these companies have a global footprint that transcends national borders. Their decisions on where to invest, how to price goods, and how to hire workers have huge implications for the economy. A 2020 report found that the combined revenue of the world's 10 largest companies exceeded the GDP of most nations, including the United Kingdom. While presidents may introduce tariffs or create trade deals, they can't control the supply chains, which are influenced by decisions made by companies in places like China and Europe. For instance, President Trump's trade war with China in 2018 caused disruptions in global supply chains. But it was the market and businesses that had to adjust, not the president. So, who's really in charge? It's a mix. The economy is a product of many factors, and while presidents can steer the ship, they don't control the tide. The market, the Federal Reserve, and multinational corporations play significant roles in determining economic outcomes. In conclusion, it's clear that while presidents have power, they aren't the sole architects of the economy. There are many forces at play, forces that often work independently of the president's agenda. The invisible hand of the market is real, and it often has a stronger influence than any individual. Chapter 4: Executive Orders versus Economic Forces. A power struggle. Presidents have tools at their disposal to influence the economy, and executive orders are among the most powerful. However, these orders often face resistance, and their effects are limited by broader economic forces. Take President Franklin D. Roosevelt, for example. During the Great Depression, he used executive orders to launch the New Deal, which helped create jobs and stabilize the economy. His most famous executive order, the National Industrial Recovery Act of 1933, aimed to boost industrial recovery but was ruled unconstitutional by the Supreme Court in 1935. While Roosevelt's orders were bold, they couldn't override the economic forces at play, like consumer behavior or global trade. Even the most well-intentioned executive orders can struggle to create long-term change. For instance, President Obama's executive actions on climate change, like the Clean Power Plan, faced significant pushback and were eventually scaled back under President Trump. These examples show that executive orders may start the conversation, but the economy often resists or adjusts in ways presidents can't predict. President Trump issued a series of executive orders, including the controversial tax cuts, which were meant to stimulate business growth. While the tax cuts did lead to short-term gains for corporations, they also added to the national deficit. The economy's response showed that executive orders alone can't guarantee prosperity, they need to align with broader trends. In fact, a 2020 study by the Congressional Budget Office found that while tax cuts may boost economic activity in the short term, their long-term effects on economic growth are minimal. One of the most significant tools a president has is the ability to influence market sentiment. For example, when President Obama announced the bailout for General Motors in 2009, stock prices rose, signaling confidence in the recovery plan. Yet, the actual recovery came from rebuilding consumer trust and demand, which was outside the president's direct control. Despite these challenges, presidents do have influence. For example, the Dodd-Frank Act, signed by President Obama in 2010, reshaped financial regulations after the 2008 crisis. While the regulations were a form of economic intervention, their full effect depended on how financial institutions responded. These examples show that presidential power is constrained by both legal boundaries and larger economic dynamics. In the end, executive orders can spark important economic shifts, but they're just one piece of the puzzle. Real economic change takes time and requires cooperation from multiple sectors. Presidents can shape the conversation, but the forces at work are often beyond their immediate control. Chapter 5: Presidents and the Economy, Heroes or Scapegoats. When the economy thrives or falters, presidents are often either hailed as heroes or blamed as scapegoats. But is it fair to place all the responsibility on their shoulders? In reality, presidents often have limited control over the larger economic forces. During the 1980s, President Ronald Reagan was praised for the economic boom, often credited to his tax cuts and deregulation policies. However, the economic growth that began during his presidency also had roots in technological advancements and global shifts that were beyond his direct influence. On the other hand, President Jimmy Carter is often remembered for facing the challenges of stagflation, a combination of high inflation and unemployment. Despite his best efforts, the economy did not recover during his term, and he was blamed by many for the crisis. But experts later argued that the stagflation was largely driven by external factors like the 1979 oil crisis, something no president could easily control. A study by the National Bureau of Economic Research found that oil price shocks, not domestic policies, were a major factor in the stagflation of the 1970s. Similarly, during the 2008 financial crisis, President George W. Bush faced criticism for his administration's role in the housing bubble. However, many experts pointed to larger systemic issues within the global financial system, particularly the widespread use of subprime mortgages and risky lending practices, which were not solely under presidential control. According to a 2010 report from the Financial Crisis Inquiry Commission, much of the blame for the crisis lay with Wall Street, not Washington. In contrast, President Obama inherited the aftermath of this crisis and was praised for his swift response. His American Recovery and Reinvestment Act, worth $787 billion, helped stabilize the economy and created millions of jobs. While critics argue that the recovery was slower than expected, data shows that unemployment dropped from a peak of 10% in 2009 to 4.7% in 2016. A study by the Council of Economic Advisers found that the stimulus package saved or created up to 2.5 million jobs, although the economic recovery was a global effort. Despite all these efforts, presidents often bear the weight of the economy's ups and downs. Political scientist Douglas Hibbs' Bread and Peace model suggests that voters tend to link the economy directly to presidential approval, regardless of the underlying causes. This trend means presidents may face blame for crises they didn't cause or credit for booms they didn't entirely create. In truth, while presidents can influence the economy, they can't control all its outcomes. Economic cycles, global trends, and unforeseen events like natural disasters often have a much larger impact. The economy is a complex system, and presidents are just one part of the equation. Chapter 6: The 2024 Forecast. How will today's president shape tomorrow's economy? As we look toward the future, many are asking how President Joe Biden's policies will shape the U.S. economy in the coming years. Biden's presidency has been marked by significant spending packages, including the $1.9 trillion American Rescue Plan and the $1 trillion Infrastructure Investment and Jobs Act. While these measures have helped drive economic recovery, they've also raised concerns about rising inflation. In 2022, inflation hit a 40-year high, reaching 9.1% in June, before beginning to ease toward the end of the year. Experts are divided on whether Biden's spending will lead to long-term economic prosperity or set the stage for future economic challenges. The Biden administration's focus on expanding social safety nets, investing in green energy, and promoting economic equality has been praised by some, but criticized by others for potentially creating government dependency and driving up the national debt. According to the Congressional Budget Office, the U.S. debt-to-GDP ratio hit a staggering 133% in 2023, prompting concerns about future fiscal stability. The role of the Federal Reserve also looms large. The Fed has been aggressively raising interest rates in an effort to curb inflation, a move that has sparked fears of a potential recession. A 2023 report from the International Monetary Fund warned that tighter monetary policies could lead to slower economic growth globally. However, the US economy's resilience so far has led some economists to remain optimistic about a soft landing, a slowdown without a full-blown recession. On the global stage, the ongoing trade tensions with China and other nations could have significant implications for US economic growth. President Biden has continued many of the trade policies initiated by President Trump, including tariffs on Chinese imports. While these measures aim to protect American jobs and industries, they could lead to higher costs for consumers and disrupt global supply chains. Technological advancements will also play a crucial role in shaping the economy. From AI and automation to clean energy, the next decade could see massive shifts in employment patterns and economic sectors. Biden's focus on investing in technology and infrastructure may position the US to lead in these emerging industries. However, a 2023 study by the World Economic Forum predicts that automation could eliminate up to 85 million jobs by 2030, challenging policymakers to find solutions for displaced workers. Looking at the 2024 forecast, it's clear that the actions of today's president will have lasting effects, but the broader economic landscape will depend on many factors. Presidents have the power to guide policy and respond to crises, but global events, technological advancements, and economic cycles will continue to shape the nation's economic future. Whether Biden's policies will lead to a prosperous future or present new challenges remains to be seen, but one thing is certain: the economy will keep evolving, with or without presidential control. In the end, the economy is a complex web of forces, both seen and unseen. Presidents can influence certain aspects, but they are not the sole architects. The future will be shaped by a mix of presidential actions, global developments, and the ever-changing dynamics of the market. Don't forget to subscribe for more insights into the economy and politics. Stay tuned for more deep dives into the world of presidential power and economic change.